Well, the bank earnings season will kick off on Friday with JP Morgan and Wells Fargo reporting their earnings. Jim, what are you going to be looking for? I mean, these banks are so huge. There's so much to look at. Are you going to be looking at their mortgages? Are you going to be looking at, are they letting more reserves losses go?
Great questions. And I've got to tell you, Stephanie Lincoln and I, co-portfolio manager of Action Awards, are both very concerned because the group is run. Group's up 20% going into these numbers. We've seen a series of very smart downgrades. We have substantial position for the trust in JP Morgan and Wells Fargo. I can't tell you that I expect the numbers that people want. I have a piece in Real Money this morning talking about the paychecks problem. It's like people feel that, well, wait a second, the interest rates have gone up, so they're not paying you anymore on CDs. Rate Watch does a great job of monitoring CDs. It's an outfit in the street, and not just promote it. I'm just saying we issue the release that tells you CDs haven't repriced. So you have this kind of lag where higher rates will eventually produce better earnings, but not yet. Will eventually produce higher net interest margin. I don't think it's going to be yet. In the interim, housing affordability has gone down dramatically because of the rise in mortgage rates. Ben Bernanke may have put in a savior by what he did yesterday by saying, listen, he's still going to be accommodative, but there could be a glitch in earnings. Now, it's the glitch that refreshes. I think these stocks remain very well positioned for growth in employment. I sure would like some clarity on regulation. I'm going to be speaking to Jamie Dimon tomorrow, Chairman CEO of JP Morgan. Does the country want them to lend? Does the country want them to raise money? You can't do both very well. You can't be told by the regulators, listen, we want you to be cautious, but also be told by other ends of the government that you must lend more. I want to know whether, to me, that's a conundrum that can't be solved.
They are definitely outsourcing more to consultants, and that's what I'm hearing, because they truly can't get their hands around what is going on in the regulatory environment, and their people within don't have the capability to know all the latest goings on in Washington, so they're having to hire people to figure it out.
Fed? I mean, let's say JP Morgan's board says we want to raise the dividend. Could someone from the Fed say no? I mean, is that right? They won't say no to Caterpillar. They won't say no to Verizon. Is this all because the capital's got to keep building up? How high does capital have to go? Aren't the banks in much better firm than in any other country? So I've got to tell you, I'm very nervous. I'm very nervous about Wells. I'm very nervous about JP Morgan, but that's short term. Wells has missed repeated quarters in terms of what people want in net interest margin. And what's it done? It's gone from 35 to 42. Now it's pulling back. JP Morgan's gone from 36, 55, pulling back. You got to buy the pullback because it won't be. It'll be the beginning of net interest margins going forward being better.
All right. So it sounds like you might have. It's kind of that bad is good.
If you don't own them yet, why buy them now? Buy them tomorrow.
All right, there you go. Jim's expecting a pullback in these banks. So wait, have your finger on that buy button, but wait until you can get a good price for them.